So, talking about using life insurance to buy real estate, I want to start with a quick story about Justin. So, I met Justin a couple years ago, and when I met him, he was part of a real estate group that recommended he should get life insurance. So, he was interested in a life insurance policy, and he was specifically interested in it for the cash value. So, he wanted this life insurance policy, and he wanted it so much that he was going to start with a policy where he paid $125,000 right out of the gates. So he was interested in using the policy specifically for real estate. However, the policy he was sold was not that attractive for real estate when we look at it. So here's the policy he was sold. Starts out with $125,000, pays $75K per year. How old is he? 31 years old when he started. Is this a good policy? Well, when we look at it, it took him about 7 years just to get his money back when we look at that. So that's a long time in my opinion. And how's that cash value growth? Not that attractive, is it? What if I sold you this policy and I said, this policy is the best deal you're going to get? In fact, the individual that owns the real estate group that you're part of, he has a policy just like this. He loves it. He uses it to buy and sell real estate. You're set up for success, because that's what Justin was told. So pretend that that's you. You get this policy. You're led to believe it's the best possible policy you can get that's maximized for cash value. And then you see this policy, which is the same policy with the same company, but it's just set up differently. So your out-of-pocket is exactly the same when we look at it. Does it take 7 years to get your money back? No. How long does it take to get your money back? 3 to 4 years. What else? When we look at the cash value growth, what do we see there? Well, it grows a lot faster. When we look at the policy itself, what's the cash value difference there? It's a big difference there. What that's showing in purple is how much more you have in cash value from start to finish with the example on the right compared to the example on the left. So if you got the policy on the left and you were told this is the best policy you're going to get, and then you get this one afterwards, and the goal is to use this policy for real estate, how would you feel? Well, you might feel like this because you walked away with a lot less in cash value than what you could have had. If you have more cash value, that means you have more money to use for real estate. The thing is, what happened to Justin happens to a lot of real estate investors, and frankly, a lot of people that are just interested in whole life insurance for the cash value. So the concept of using a whole life insurance policy is often attractive to individuals. And we'll get into exactly why. It has to do with your money always compounding for you. But what happens is people often get a policy, but they find out after the fact that that policy could have been set up for more cash value from the get-go. And the problem with that is that after you start a whole life insurance policy, if you find out it could have been better, you could have had more cash value up front, could have had more cash value long-term. A lot of times it's really difficult to make changes after you start a policy. It is possible to make changes, but often it's difficult. So we'll show you how you can prevent that altogether. Okay, so what we'll cover today are 3 things. First, we'll talk about why real estate investors put money into whole life insurance. What's the advantage to doing this? Like, why do they actually do it? What's the appeal? Number 2, how to choose the right policy. This is the most important piece, in my opinion, making sure we get it right from the beginning. And then number 3, we'll have some fun with this. We'll review the numbers. We'll take a look at the numbers and see what things actually look like. What are the pros and cons to you? What are the pros and cons to the insurance company? I want to understand what questions I should be asking and not just move forward based on concept alone. We're going to look at exactly that, what your money's growing by compared to what you're paying in loan interest. And what I want to mention too is if you're newer to this, some of this might feel hard to digest, like it's a ton of information. First off, you're not alone. That is perfectly fine if you feel like that. I'd encourage you to take your time with the research and such. But I'll also let you know that we absolutely love this stuff here. So if you'd like more information or you'd like to learn more, you can always let me or my team know, and we'll always show you how cash value life insurance works with your personal situation. So the goal of this presentation is to show you personally how you can take advantage of cash value life insurance to purchase real estate. Sound good? All right. First, a couple examples of people that I've worked with for a long time now, or companies worked with for a long time, that use their policies to purchase real estate. First, we've got Max. So Max pays $600,000 per year into his whole life insurance policies. That's a lot of money per year he pays into his policies every year. Right now, he's got more than $2.5 million in cash value that's just compounding for him like a machine, but he didn't start out with that big amount. When he started his policies, he had a minimum of about $10,000 per year. So he wanted to start small and be able to add more money as he got more comfortable with it. Now, he uses his policies a lot for real estate, mainly because he prefers not to work with banks. He wants to be able to move fast when a real estate deal comes around. Really, what he's done with his big bucket of cash value, he's created his own source of financing that he can use for real estate opportunities that he finds attractive. So that's a nice example of a big old policy. How about a smaller one? Next, we've got David. So he started a policy with a lump sum that he saved up over time. It was 75 grand, but now he pays $7,500 per year. He can add more, but that's what he's been paying. And he actually used his policy to make a down payment on his first house for him and his family. Pretty nice, right? The key takeaway here is it doesn't matter if you're putting $1 million per year away or $10,000 per year away. Anyone can do this, provided the policy is set up correctly from the beginning. So let's get into the details, but first, a little bit about me. So if you don't know me, hi, my name's Steve. That is my lovely wife, Tara, in that picture. In my free time, I like to teach a little bit more than 37,000 people, all about the wonderful topic of whole life insurance and a few other products and services too. I'm the founder and CEO of IVC Global. Our company currently serves about 3,000 clients, and one of our largest clients is a bank. I promise that is all true, and if you'd like to have a conversation about life insurance, I promise we'll keep it interesting. Now, before I started the company and started teaching about cash value life insurance, I learned a lot, specifically working for other people, but there was one company I worked for. It was an executive benefits planning firm. And what that term means, executive benefits, it was a company that set up cash value life insurance policies for corporations. So a corporation would come to the firm and say, we want cash value life insurance. We want to take these policies out on our executives. And my role was a back office role where I got to set the policies up for maximum cash value and test out different products and companies, nerdy stuff. So if you like numbers, you would love it. But what I really learned here were specific details on a couple things. First and foremost, how to maximize cash value, how the rich and corporations structure their policies, and really how you can copy and paste that method to anyone. And then this is a really important one. What life insurance companies do I choose for my actual whole life insurance policy? So after I learned everything there is to know about whole life insurance, just kidding, because we're always learning. But after I learned a lot, I eventually decided to go off and start my own company. I found this beautiful office, which was this guy. I'm not kidding. So you can see my ride to work, that four-wheeler. I'm kidding. That wasn't my ride to work. But you also see my office on the right, which that was and still is my office, actually. We've renovated the building a couple times. It started out just with that side of the office. There are 2 desks and a half a wall where me and my friend Becky, who was a part-time assistant at the time, that's where we started. Since then, we have renovated the office a couple times, first to a commercial office, but then to a recording studio. So if you stop by to visit, it's a lot nicer now than what it looked like before. And the company's grown a little bit too. This is a recent picture from about a month ago, a little bit more actually. Our company is about 35 right now, 35 employees, and they are all absolutely fantastic people and very, very good what they do and what they do in their specific departments. So on to what we're going to cover. Number 1, why real estate investors use whole life insurance to buy real estate. What are some of the benefits of a whole life insurance policy? So if this is you considering a whole life insurance policy for real estate, like, why are you doing it? If someone asked you, why are you doing this? What would you say? Here's some reasons why. Number one, guaranteed growth on the cash value. No matter what happens, your money goes up. Another reason, a lot of times we see people don't trust banks, or they're tired of working with banks, the paperwork, the underwriting, the long delays. That's another reason. Number three, really convenient. You'll find that it's really easy to access cash value, and it's also fast. Typically, when you access money in a life insurance policy, on average, it's 2 to 3 business days, and it's always sent direct deposit. Here's the big one, point number 4. The insurance company is going to continue to pay you dividends regardless if you use your cash value or if you just let it sit and grow. Meaning, if you decide to use that policy, your cash value keeps on compounding. That part can be a little bit confusing. We're going to talk about that more. And then the last point is more of an end game stage where I want to use the policy to generate income. So maybe I have a real estate portfolio, that's my retirement income, but I could also use the cash value in my life insurance policy. And if you do everything right, it's tax-free, which is really, really nice. Let's continue on. So how it works, getting a life insurance policy specifically for real estate. I get a whole life insurance policy specifically for the cash value, and I take loans to buy real estate. When I say specifically for the cash value, it is extremely common to hear someone we speak to for the first time say, I don't care about the death benefit. I'm getting this policy because I like the cash value. The death benefit might be important down the road, but right now, I'm interested in that cash value. Then a lot of times, we'll see people are interested in this. Instead of borrowing from a bank to finance real estate deals, they'll use their life insurance policy. Why would you do that? 2 main reasons, control and compounding. Let's talk about control first. So if you're going to take a loan from a bank, who's in control of that loan? You or the bank? We know the answer to that question. It's the bank. If you're going to borrow from your life insurance policy, who's in control? Is it you or the life insurance company? It's you. You've got control of how and when you pay that loan back. A lot of times, if you pay it back at all. Here's a nice piece. This is actually from New York Life. Probably have heard of that life insurance company, but it's a nice piece because it compares a bank loan and a policy loan and some of the pros and cons to each. A point I like a lot is point number 3, which is the loan amount is limited to the policy's available loan value. So what that means is whatever you have in cash value, that's the maximum loan you can take. So why someone might go with a bank instead of a life insurance policy is to buy a house. Let's say you're buying a house, it costs $500,000. You don't have $500,000. That's where someone would go to a bank. That's a very common example. But with a policy, once I've capitalized it or have cash value in there, that's where I can go to it. It's very, very convenient, and my money keeps compounding. We'll talk about that in a little bit. So on the compounding, your cash value goes nowhere but up over time. 3 main items that people are attracted to. Number 1, your money grows safely, meaning there's no risk. Regardless of what happens in the stock market or the economy, your cash value just keeps on going up. 2, you can access your cash value while the money keeps on compounding. And then 3, it's got a really nice tax benefit, meaning if you do everything right, it's tax-free. What point jumps out at you? Or what point do you have questions on, if any? A lot of times it's point number 2. You can access your money while it keeps on compounding. What does that mean? So let's pretend you have a life insurance policy and you don't take any loans. We'll pretend you've got $100,000 in cash value. We'll assume it's earning 5%, 5% net, so not the dividend rate, but the actual growth rate. Today, you've got $100,000 in cash value. $100,000 at 5% equals $5,000. So if you don't touch it, you just let it sit and grow, after 1 year, you'll have cash value of $105,000. Make sense? Cool. Let's look at the same scenario, but with taking a loan out. So now, when I look at that same policy, but with loans, we'll pretend we take a $50,000 loan. When we borrow against a life insurance policy, we do have interest or a cost to borrow. In this example, we'll look at a 5% interest rate. 5% of $50,000 is $2,500. So that's what you paid, but here's the why right here. This is why people do this. You still earn 5% on the full $100,000, even though you've borrowed $50,000. So you're still getting that $5,000 on everything. So after 1 year, assuming you pay it back in this example, what you would see is that you have a cash value of $105,000, which is exactly the same as what you would have if you didn't touch it at all. Make sense? We'll look at an example of this a little bit later. We'll look at an actual policy with and without loans. But why people are interested in this right here, my money keeps on working for me. So if I know I can earn a rate of return with a piece of property, with real estate, but I've got the money in the policy first, keeps on compounding. Does that remind you of anything? About real estate. So let's go through the same exercise, but this time we'll use a property instead of a life insurance policy. Let's pretend you own a property and it's valued at $100,000. The fair market value of that property goes up by 5% every single year like clockwork, no matter what happens in the economy. So after 1 year, it'd be worth how much? $105,000. So 2 questions here. If you own that property outright, do you still get the 5% appreciation on it? The second question, if you have a mortgage outstanding on that property, do you still get the 5% appreciation on it, on the full property value? The answer to both questions is yes. If your property is worth $105,000 and that's what you sell it for, that's what it's going to sell for. The difference, like when we look at these 2 questions, is if you own the property outright and you sell it, how much will you get? $105,000. If you have a $50,000 mortgage outstanding and you sold the property for $105,000, how much would you get? Well, the bank would get their $50K back first, and then you get the remaining $55,000. That's the difference. However, if the property appreciates by 5%, you continue to get that. So when we look at a whole life insurance policy, it's the same thing. You continue to earn that appreciation on your entire asset. Make sense? So to summarize this point, as far as buying real estate with a whole life insurance policy, here's why people do it. I get a whole life insurance policy for the cash value. The cash value is a safe place to put money that I can access tax-free and I can also borrow against. But when I look at borrowing against it, I know the money will keep compounding for me when I have that loan outstanding. So there's no lost opportunity cost. Here's a quick, simple example. I get a whole life insurance policy. I fund it with any amount of money every year. I see a property that produces a 10% return. I say, I want that property. I take a loan against the policy to buy the property. I pay the loan back however and whenever I want. But when that loan's outstanding, my money keeps on working for me. So I get the constant compounding on whatever I've paid into the policy indefinitely. That's why people are attracted to it. And again, we're going to look at the actual numbers here. But what I want to mention first is this is really important. We still have a cost to borrow. I don't want to overlook that, because just like real estate that you might own, If that fair market value appreciates by 5% every year, that's really, really nice. However, if I have a mortgage outstanding and the cost on that mortgage is 5%, I need to account for that too. It's going to impact the net return. So we'll do that a little bit later when we look at the actual numbers. Hope that part made sense. So why real estate investors use whole life insurance? That was why. Next, how to choose the right life insurance policy. This is the most important piece, because if we go back to the story about Justin, where it went wrong for him was that initial policy setup. Let's start with the basics here. So whole life insurance, how does it work? We've got 3 colors here: blue, red, and green. We'll start with blue. That's the death benefit. That's the actual life insurance policy. When you die with a whole life insurance policy, the death benefit is paid out 100% income tax-free to your beneficiaries. Typically, you'll see it gradually increase over time as well. Next in red, you've got your premium and PUA rider. What's PUA mean? PUA. Paid up additions. I like to call it a cash dumping. This is money you deposit or money you pay into the policy. Here's a quick question. When you hear the word whole life insurance, and then you have the word premium here, how long do you think you have to pay premiums into a whole life insurance policy? Is it your whole life? Hence the name of the product? No. You can have a policy where you add money for a few years. It could be forever, or you stop and go. The actual dollar amount that you add fluctuates. You can set it up to be very flexible, is my point. And then we've got the piece that everyone's interested in, the cash value. So with the cash value, we'll see it go up in value every single year. There's no risk, meaning it's not tied to the stock market. I've got strong guarantees, and I can also access it completely tax-free if I do so properly. So how do I choose the right policy, and what's important to me if I'm going to use it for real estate specifically? Here's it. 3 main points. 1, maximizing the cash value. This is always number 1, in my opinion. 2, flexibility. And then 3, loan convenience. Talk about this one really quick. This is just being able to access your money quickly. So not having to run into delays or anything like that. We mentioned earlier, I can typically access a loan in 2 to 3 business days. The flexibility is big. We'll hit on this later. What that means is you have the ability to pay a lot of money into a policy, but not get a big bill that you're on the hook for every year. That's important to a lot of people. So let's talk about maximizing the cash value first, and we'll go through an exercise here. You're going to take out a policy, pretend you are, where you want to pay $10,000 per year. And you want to get the most you possibly can out of this $10,000. We're going to look at one policy with one company, one product, but 3 different options. So we're going to look at a guardian policy here, where someone's paying in $10,000 per year for 10 years. Make sense? All right. We've got option A, B, and C. Which one do you choose? Let's look at A first. So you can see the name of the product here, a Whole Life 95. We've got a 40-year-old male, and the health rating is standard non-smoker. Option A, what's he paying? $10,000 per year. That's just premium. Remember that chart where you had red, premium, and PUA? Here, you've got $10,000 going toward the premium. How long do you pay into it? $10K per year for 10 years. What do you pay after year 10? Nothing. What's your cash value look like in the first year? Not that attractive, almost 0. So it's almost negative 100% return. Now let's look at the same product, but set up a little bit differently. Here we've got option B. Instead of paying $10,000 to the premium, you pay $5,000 toward the premium, and the other $5,000 toward your paid up additions rider. That's that cash dumping. What's your total out of pocket? We'll add the 2 together. You've got the $10K per year for 10 years. After that, you don't pay anything in. When you look at the first year, what do you got? $5,000 instead of $300. Looks a lot better, doesn't it? Option C. What's your premium? Less than $1,000, $910 in this example. What's your PUA? $9,000. How much do you pay in? $10K per year for 10 years, same out of pocket. What's your first year cash value? It's a lot more attractive than the other two examples, isn't it? Yeah. So which option got you your money back faster? Well, if we look at the three side by side, option C, you get your money back by year 4. And what I mean when I say get your money back by year 4 is that your cash value is equal to your total payments. So if you look at how much you're paying in each year, $10K per year, by the 4th year, what's $10,000 times 4? $40,000. How much do you have in cash value? $40,182. If you look at the same point in time with option B, what do you have? $35,000 in cash value. What about option A? You paid the same $40,000 in, you've got $28,000 in cash value. See the difference there? Again, same company, same product. All we did is set the policy up differently. And why this is so important to so many people, especially real estate investors, is if I've got more money up front, I can use that for real estate or whatever I want sooner as opposed to waiting a long time to get my money back. So which policy gives you more money short term, particularly upfront in the first year? Option C. Got 8751, which is a lot more than the other two. How about by year 10? Option C. How much do you have there? $118,000 in change. Option B is almost 108. You've got more than 10 grand in option C. How about by year 20? Again, option C, you're at 191. The runner-up is option B, where you're at 176. Starting to notice a difference here. What about by year 30? Now we're really looking at long-term. And remember, you didn't pay anything after the 10th year. What's the winner? Option C. That's the only option that cracked $300,000. The other two are still in the $200,000 range. So what do you notice here? Option C has the most money from start to finish. Why is that? I know we went through those illustrations, but those things can be confusing. They're like stereo instructions, right? You see the premium and paid up additions rider. Here's why. So we had the same insurance company, same product. He pays 10 grand every year, the base premium and the PUA rider. When you pay money into a life insurance policy, the $10,000 in this example, it can go toward one of two areas. Do you remember where it went in option C, what that base premium was? It was less than $1,000. Base premium dollars, first, prioritize life insurance. Second, prioritize cash value. Whereas PUA dollars, prioritize my cash value first and life insurance second. A question we get a lot is, can I just put all of the money I want to pay into this policy into my PUA rider, nothing toward the base premium? Can you? No, we can't go quite that aggressive, but we show you how you can get as aggressive as possible. So if we look at the three options side by side, here's option A. Your base premium is $10,000. Your PUA is what? 0. As a result, you have the lowest cash value. Option B, what do you notice here? $5,000 premium, $5,000 PUA. More cash value than option A, but when compared to option C, well, now your premium is at about $1,000, a lot more going toward PUAs, so you've got a lot more cash value as a result. So if maximizing cash value is the goal, so that way I've got more money that I can then use in my policy for real estate, here's the method to copy and paste. And this is exactly what we did for corporations. Minimize the base premium, maximize the PUA rider. And what you'll find is that a lot of the top life insurance companies will allow us to drive that base premium as low as 10% of whatever our maximum is. What do I mean when I say that? Of whatever our maximum is, because that can be confusing. So we go back to the example we just looked at, where I said I want to pay a maximum of $10,000 on any given year. Here's how it works. I want to pay 10K. My base premium, which is my minimum commitment, is $1,000. Then the other PUAs of $9,000 can be added at my leisure. Now, depending on the actual life insurance company, leisure can have different definitions, but we can talk about that another time. What if I wanted to add a zero? The most I want to pay is $100,000. My base premium, 10%, $10,000. That's my minimum commitment, which means I can add another $90,000 at my leisure. So, hope that point made sense about the 10% minimum premium. Flexibility. This point is extremely important to real estate investors. A flexible policy lets you commit to a small premium that never feels like a burden. This is a concern to a lot of people. So I can commit to a small amount that I'm more than comfortable paying, and then at my discretion, I can add more money to PUAs. So to demonstrate that, if we go back to option C, here's our policy. What's your minimum? As far as if you had this policy, if you said, what's the minimum that I have to pay when I started? Because I want to pay 10 grand per year, but I don't want to have to be on the hook for writing a check for 10 grand per year every year. Same is true if you want to pay $100,000 per year every year. Well, that minimum here is $1,000 per year. So I'm committing to that, and then I can add more money to the policy at my discretion. Make sense? Let's look at a couple of examples here, and then we'll get into the demonstration of how we can use it for real estate with loans and such. So we've got Lance here. Lance is a real estate investor. He wanted to fund a policy with $120,000 per year for 5 years. I met him back in 2018, and he started his policy in 2019. Now, during the initial conversations, he said, right now I'm doing well. He's in the mortgage industry. He was concerned about another 2008 occurring. He said, I can fund this policy with 6 figures per year. Steve, I get nervous. Like if my income drops, I don't want to be on the hook for a big dollar amount because I don't want it to feel like a burden. That's the stress that he had. So how we set the policy up and what he ultimately ended up going with was a policy where he had a minimum commitment of $13,200 per year. That's what he's billed for. And he can pay a maximum of $120,000 per year. So he started the policy in February of 2019. Want to see what it looks like? Here's the actual results. This is pretty cool. So this is his policy, by the way. So 6 years into it, what was his original plan? To pay how much? 120K per year for 5 years. This is 6 years. So things have gone well. And he said, you know what? I really like the way this is performing. I want to add more money than what I originally planned. Can do that, no problem. On the far right, you've got the cash value growth, and this is the net dollar amount that he's getting from the life insurance company. So this year, he gets a net of almost 25 grand as far as what he's receiving from the insurance company. And he recently took a loan from his policy for about $500,000 for guess what? Real estate. He's got a fixed interest rate. It's actually 5.66%, but a little over 5.5%. And he works for a bank. For the longest time, he had just continued to leverage his equity in real estate that he owns because he could get a lower loan interest rate. Now that's not the case. So he's flipped over to his life insurance policy. So again, this is a real policy. We see the projection of what it looks like moving forward. The cash value just keeps on compounding and he's really happy with it. In this model, we're assuming after year 6, he doesn't pay anything else in. Although if he decides to keep adding money, he can. And I just talked to him actually. He might keep adding money or he might get a policy for his wife. He's not sure yet. So again, real policy, funding 120 grand per year. I know it's a big number. So if you see that and say, okay, that looks good and all, Steve. Like, I like the idea of funding a policy aggressively and being able to use it for real estate. But what if I don't have $120,000 to put into a policy every year? What if I don't even make that in a year? That's a huge number. Well, going back to the earlier examples of Max and David that we mentioned, can work with any amount of money. So we'll look at an example of $500 per month and then also $30,000 per year. $500 per month first. So this is a 30-year-old female. Her minimum commitment is about $100 per month. However, here she's paying $500 per month or $6K per year up until the age of 65. That's her plan, but she doesn't have to pay that long. Next, we've got a 50-year-old individual. His minimum commitment is $300 per month, but he's paying a lot more than that, $30K per year. He gets his money back between years 4 and 5. When we look at it up here. And after the 15th year, when he's not paying anything else in anymore, what do you notice? Cash value is growing by how much? $30,000. What was he paying in before that? $30,000. Now he's getting from the insurance company what he was paying in every year, which is pretty cool. But it demonstrates that as long as we set the policy up right, it can work with any amount of money. Last point I want to hit on as far as getting the policy right from the start. What life insurance company should we choose? Because there's a lot of them, and it's difficult to choose. We can look at one company and see 8 different products with one company. It's like, how do we choose with all of these options? There's a lot more than what we have up on the screen here. Here's what I would do. Instead of just taking my advice, I would ask these questions. First, what companies are wealthy families and also the advisors that they have recommending and using? When I say wealthy families advisors, I'm talking about CPAs and tax attorneys that have experience with cash value life insurance, not a licensed life insurance agent that has an interest in selling the policy, someone like me. Another good question. What companies do banks use? What companies do corporations and small businesses use? A simple thing you can do when you're trying to get the right policy, follow the money. Another thing you can do, if you like numbers and analytics, is see what life insurance companies provide proof that their policies have actually delivered over time. And what this means is not just a good-looking illustration, but a company that can say, here's a policy from 30 years ago, and here's the net return on it, the internal rate of return. Where we've gotten this proof from and who we see these guys use up top are these guys right here, your 4 major mutual companies. Here's what I always like to say. If your goal is to maximize cash value, regardless if I want to use it for real estate, whatever it might be, I want to maximize the cash value first. I'd make sure the policy is set up properly, but I would always, at the bare minimum, consider at least one of these companies. And the simple reason why is because we've seen consistent proof from these companies that they actually deliver. Now, pushback I receive from my peers sometimes are things like this. They don't support infinite banking, we hear a lot. They're direct recognition, or you want a small to medium-sized company because of some reason that I'm like, all right, that doesn't make any sense. Like, follow the money here. Here's the thing. Being in the industry, when you look at these 4 major mutual companies, they do pay the lowest commissions in the industry compared to what we would receive as an agent from other life insurance companies. That's how it works. Just when we look at the net numbers, like, it is what it is. So what we'll always recommend is one or multiple of the 4 major mutual companies. Here's some dividend history from 2 of them, which are the 2 companies we do use the most, Guardian and Mass Mutual. And that's how we get the policy right, making sure it's set up right. What are the 2 main things there? Policy design, where your money can go between premium and the PUA rider, and then also company selection. I would always look at the 4 major mutual companies. All right, last point here. how do I actually use a life insurance policy to buy real estate? So some case information here when we look at this. We're going to look at a case study that's based on a 45-year-old individual. He's going to fund a policy for 5 years with $500,000 total, 100K per year for 5 years. After the 5th year, he pays 0 in, kind of like Lance's goal, but Lance kept on adding money. What we're going to look at is buying a property for $300,000. The loan interest rate in this example, 5.56%. Now he wants to use the policy, in this case, as his own source of financing, kind of like Max did initially. He wants to use it for real estate. And then what he's going to do specifically is pay that loan back in 8 years. All right. Here's what we want to look at though. What are the benefits to you if this is you in this strategy? And then what are the benefits to the insurance company, specifically with the loan? So first, funding the policy. What's he paying in? 100K per year for 5 years. What about after the 5th year? Doesn't pay anything in. Year 6, the first year he pays nothing. He's 50 years old. What do you have in cash value? Just about $535,000. What's your death benefit? $1.8 million. You let it sit and grow. At age 58, what do you have in cash value? $754. Death benefit still 1.8. Eventually that death benefit begins to go up. Have those figures in mind. Back to age 50, 58, keep them in mind, because now we're going to look at a policy loan. So here's the same policy, but with loans. Whoa, we got a lot going on there. One column at a time. First, let's look at a $300,000 loan. So we take that policy loan, okay? What happens? Well, when you take that loan, your cash value drops to $218. The death benefit drops to $1.5 million. What was it before the loan? $1.8 million. The death benefit dropped exactly by the amount of the loan. And you'll see that happen anytime with a life insurance policy. Think of it this way. If you're the life insurance company, what is your first and foremost obligation? To pay out life insurance claims. So if someone dies with a loan outstanding, what happens is the death benefit is paid minus whatever the outstanding loan is. So that's our value there. But now we're going to start to pay the loan back. So we pay it back at $50K per year. Takes 8 years. We can see what's applied toward the principal in purple and then what's applied toward interest in red. But when it's paid back, your cash value at age 58 is $755. Death benefits $1.8 million. What do you notice here? When it's paid back, the value is exactly the same as what it was when you didn't touch it, if you just let it sit and grow. Remember that point earlier? The money keeps on compounding for you, no lost opportunity cost. That's it right here. So where people are attracted to this is that they can use the cash value to purchase real estate, and my money keeps on compounding for me at 4 to 5%. And at the same time, I've got control. This isn't a bank loan where I'm subject to their terms. I can pay it back however and whenever I want. Sound good? A lot of times people see this and say, sign me up. How do I start the policy? Which is fantastic. However, let's talk about something that sometimes makes people feel like, why didn't you show me that in the beginning? Which is this. What's my actual cost to borrow? We've got the interest rate. In this example, the cost to borrow is 5.56%. However, here's a great thing you can do. That just makes things simple. Look at the cash value growth, which is what you're getting net from the insurance company each year. We don't want to include your payment in that. We're going to look at that and compare it with the actual loan interest cost. So let's look at the cash value growth first. Here's that same policy, 100K per year for 5 years. What do we see? Yearly cash value growth. That's what you're getting from the insurance company each year. First year, you're paying 100K. You have $92,307. Did you gain anything? No. You took a loss. There's the hit. After the 5th year, the yearly cash value growth is $22,902 because your cash value was $512. You paid nothing. Now it's $534 and change. That's how much it grew by. So the yearly cash value growth is what you're receiving from the insurance company each year and what's being paid into your policy. That make sense? Cool. Total cash value growth. This one's a little bit easier. Look at your total funding, which is your total out of pocket, then your cash value, and the total growth is the difference. So if you look at the bottom, you paid how much? $500,000. What's your cash value? $788. What's the difference between those two figures? $288 and change. That's your total growth in this example by year 15. So that's how we look at the cash value growth. Now let's do the same thing, but with the cost to borrow, the actual loan interest. So first, we'll look at the yearly interest paid. You took that loan out in year 6, and you can see what you paid in loan interest every year. First year you paid loan interest, $16,680. You paid that to the life insurance company. And then the same thing with the total interest. If you look at the bottom, after you've paid that loan off in full, how much interest did you pay to the insurance company? $75,000 and change. That's one of my favorite things to look at, by the way. And a big reason why, have you ever taken out a mortgage and maybe you got it years ago and you locked in a 3.25% interest rate? So you say, okay, my interest rate's 3.25%. But then you take a $300,000 loan out and you see the total interest you paid over time was $600,000. Like, wait a minute, that feels like it's a lot more than 3.25%. Well, if I can just see this via dollars, it makes life a lot easier. We like to simplify this as much as we can. So we've got the cash value growth and also the cost to borrow. Let's compare them side by side. So here we go. Year 7, you earned how much from the insurance company? That's the yearly cash value growth, about $24,000. How much did you pay in loan interest that year? Almost $17,000. Positive or negative? In this example, you're positive, which is great. We can make it look negative, by the way. How about by year 15? What's your total cash value growth? $288 and change. Because you paid $500, you have $788. The difference is your total gain. How much did you pay in loan interest? $75,000. This right here is often what a lot of real estate investors like to look at to make sure that when they use their policy, they're not in the red. They want to make sure that they're always in the black. They don't want to pay more in loan interest than what they're earning in the policy. Because that's happened to a lot of people. They're led to believe or under the impression that they always have a positive gain. They look at the numbers. That's not the case. How'd you feel if that's you? That's where problems pop up. We just have to have transparency here. This way we can make decisions with confidence. Like that's what we all want to do. So it's important to look at the numbers before and also after we have a policy. This is something we do with everyone we work with. We've got a loan workbook that we'll send to our customers that let them model it out, and we'll do it from a lot of times too. So covered a lot there. Before we recap, a little bit of bonus information here. So we touched on this briefly earlier. What's the end game for a real estate investor? Income in retirement. After I'm done acquiring a large real estate portfolio, now I'm retired, I want to take income. So my real estate portfolio, if I'm buying and holding forever, often produces stable income. A life insurance policy is a nice supplement because I can take additional income. If I do it right, that income can be tax-free. That can be through withdrawals and also policy loans where I'm not paying the loan back or I'm not paying any loan interest. But what if I want more guaranteed income? And that's the big word right there. Here's what we've seen some individuals attracted to. This word, annuities. So this is not a fit for everyone. There's a lot of different types of annuities, but this can be a great option to consider if I want to guarantee, that's the key word right there, guarantee some additional income in retirement. A saying that I heard that I like a lot was that it's like insurance for your money. I give the insurance company a big pile of money, which can be cash or it could be an IRA or 401k transfer, but I give the insurance company money. They say, thank you very much for your money. However, in return, we're going to guarantee that you'll have $5,000 per month in retirement when you turn 65 for the rest of your life. The number is going to vary depending on how much you give the insurance company and the age you start the annuity, but that's how they work. A lot of annuities, that's how they work. Here's a quick demonstration. This is someone that is looking to start an annuity at 44 years old with $250K. It's coming from an old IRA, actually. They're going to start taking income at 60 years old. What they're guaranteed here is about $43,000 per year or $3,500 per month, and that's starting again at age 60. So they're paid that until the day that they die. So if we look at age 90, they've gotten a total of $1.3 million. They gave the insurance company $250. The company said in return, here's what we're going to guarantee you. Here's what it looks like if they say, I want to start a little bit later. I want to start at age 65. If I defer it, I get more money. About $62,500 per year. That's $5,200 per month. About $1.6 million by age 90. If I say I don't need it by 65, I want to defer it until I'm 70 years old, and it ends up being almost $70,000 per year. So this is a tool that's sometimes used by individuals. If it's a fit, we discuss it, make sure it fits into the overall plan, but this can be a great fit if I'm looking for that guaranteed income in retirement. And then when someone wants to start, or depending on the age they want to start, we'll lay it out side by side, but they don't have to decide this. Not up front, at least. This can be flipped on when they decide they actually want to start taking income from the product. Pretty cool, right? And again, we build this into the overall plan. So now that you've learned how to use whole life insurance to buy real estate, do you see why? Number one, why real estate investors put money into whole life insurance? See the reasons why. Does it make sense? Number two, do you see how to choose the right policy? And how if a policy is set up the right way and with one of the major mutual companies, that can make a world of difference in terms of the actual cash value balance that you have access to from start to finish. Remember options A, B, and C. And then number three, you see why it's important to review the numbers. Do you see why people actually use life insurance to buy real estate after looking at the cash value growth, after looking at the cost to borrow, seeing the numbers so I can understand how it works? So from this point, you've got two choices. One, you can keep on doing your research, which is perfectly fine. I like to do a lot of research personally too whenever I'm considering something. Or two, if you feel you're ready to have a conversation, you can take advantage of all the benefits we covered today and look to get a whole life insurance policy that's set up like wealthy individuals and corporations. Now, if you listen to all of this and you feel like, oh my goodness, this is still extremely overwhelming, I don't know where to start, I'm going to simplify it for you. 4 simple steps. Number one, always start with this. Maximize the cash value. If you're looking at a whole life insurance policy, maximize the cash value first. This makes everything else flow properly. So the most financially savvy customers we work with will always, always, always do this first. Maximize the cash value of their life insurance policies. And then when I access the money, it makes life a lot easier. Point number 2, borrow against the policy. So I can borrow against the cash value to use it to fund real estate deals while it continues to compound. And then compare it with what you're doing now. So if you're doing something right now and it works for you, when you're considering this, I would lay it out side by side so you can see the pros and cons. And this way you can make a decision with confidence. Or if someone asks, hey, why are you doing this? Or why are you doing things differently than what you've explained, how you've done them for such a long time? Well, now you can say, well, I looked at the numbers side by side and it makes sense, as opposed to just hoping that it works out. And then lastly, consider all of your options. Consider all of the options based on your goals. We can look at other products like annuities and really see if that's a fit to guarantee income, like a real estate portfolio might generate income. Here's some resources that you can check out if you want to see some more information on cash value life insurance and using it for real estate. You can visit our website, you can email us, give us a call, or you can check out our YouTube channel, which we've got a lot of information on whole life insurance. So from here, we are going to have the private Q&A, which is for everyone on the Zoom call. For everyone that has live streamed the event, thank you so much for taking time out of your evening. I do appreciate it, and we'll talk to you next time. Thanks so much.